Okay, we are slowly going to get started. Thank you everyone that has already tuned in and arrived on time. I'm sure other people will still be trickling in. Hello, good morning to all those on the West Coast. Good afternoon to those on the East Coast, and of course everyone in between too. This is the webinar between the UCLA Anderson Forecast and Columbia Business School that's focused on the current policy and economic volatility, and specifically with implications for the middle market and small businesses. So my name is Clement Bohr. I'm a senior economist at the UCLA Anderson Forecast, and this is co-hosted, as I mentioned, with Columbia Business School, where we have Brett House joining us today. Brett is my former colleague and a fantastic professor there of economics. He was just recently mentioned and referenced in an article in the Financial Times about the incoming potential stagflationary scenario for the U.S. economy. So if you do subscribe to that newsletter, I encourage you to read that article. I'd also like to introduce the panelists we have with us today. So first of all, we have Jay Hawkins, who's a senior economist at PNC. We have Holly Wade, who's the executive director at the NFIB Research Center, where NFIB is the National Federation of Independent Businesses. And then we have Tuan Nguyen who's an economist at RSM. Okay. And so with that, I'm just going to hand it over to Brett, who's going to be moderating this panel. So take it away, Brett. We're very excited for this.
Well, thank you, Clement, and thank you to UCLA and CBS for hosting us today, and to our panelists, Jay, Holly, and Tuan, who are joining us to talk at a timely moment about the impact of political and economic volatility on small and medium-sized businesses in the American economy. As you know, SMEs account for about 2/3 of net job gains in the private sector, and about 43.5% of GDP, according to recent BEA data. So the middle and small market is critical to understanding the outlook for the American economy, and amidst an enormous amount of focus on the so-called Magnificent Seven, the largest tech stocks in the S&P 500, it's really an opportune time to focus on the other 490 or so and the smaller companies that drive the American economy. We'll first hear from Jay and then move to Holly and then Tuan to review some of the proprietary research and survey data that their organizations have put together to give us a clear snapshot on how the big trends in the economy are trickling down and in some cases percolating up from the middle and small market. Jay, over to you, and I'll start your slides.
Thank you for joining, everyone, whether you're on the East or the West Coast. I'm going to start out by discussing our latest macroeconomic outlook. I'm not going to go into a great detail about it, but I am going to start out talking about the labor market. Reason being is because that is one of the keys to the outlook. And you can see the title in this slide, Job Growth Suddenly Downshifted in a Significant Way in July. Not only that, actually the actual job growth in July was pretty much in line with consensus, but what was more concerning were the sharp downward revisions in May and June. And for that very reason, the Federal Reserve became very concerned that the labor market was slowing down more than they had anticipated. Now, what I'm showing you in this chart here is total non-farm employment growth, the month-on-month change, but I've taken a 3-month moving average for the data to smooth out the volatility. A couple of things I want to highlight here. If you look at the data point at the beginning of this year, job growth on a 3-month moving average basis was running at 232,000. It's all the way down to 29,000 now. So a significant slowdown in job growth. Not only that, what was more concerning is when we got the August employment report in September, July job growth was now negative. And as you transition to the next slide, I'll demonstrate why that's so concerning, because that historically has signaled a recession. So what I did in this chart here is I went back to recessions all the way back to the 1940s, and those are shaded in that gray area. It's recessionary period going back to that time period. And you can see in this chart here that when job growth turns negative, the economy is either close to or in recession. Now, when I calculated on average when job growth turns negative, it's 1 month after the recession begins. Now, I'm not suggesting that job growth, the economy is in recession. In fact, we peg the probability right now at about 40 to 45%, but it's certainly something to keep an eye on. And certainly 1 month doesn't make a trend, but we are getting, when we get the next employment report, that's certainly something to keep an eye on to see if that negative trend persists. Now, in terms of the unemployment rate, I'm showing you data quarterly here, but the unemployment rate right now is sitting at 4.3%, still historically low, but you have to remember that's up from 3.4% at the low of this business cycle. So we have seen almost 100 basis point rise in the unemployment rate, but with job growth slowing, we do expect the unemployment rate to continue rising. And in fact, we think it'll peak at about 4.7% out in mid-2026. Next slide, please. So with job growth slowing, unemployment rate rising, we are expecting real or inflation-adjusted disposable income growth to slow. That's what I'm showing you on this chart, the percent change from a year ago in real disposable income. You can see back all the way in 2023 Q4, it was sitting at close to 5%. Latest data point we have from Q2, it's down to 2%. You can see we're expecting a slight bump up in Q3, and then disposable income growth is going to decelerate just above 1%, 1.5% or so out in mid-2026. Next slide, please. And of course, that's going to weigh on consumer spending growth. What I'm showing you here, again, is real or inflation-adjusted consumer spending, the quarter-on-quarter annualized percent change, the same way GDP is calculated when you hear about that. A couple of things to point out on this chart. You can see at the end of 2024, it was sitting at 4%. It's only at 1.4% now. So the labor market, there's much more slack in the labor market. Employers don't have to, it's not nearly as tight as it was. So employers don't have to raise wages to retain or attract those workers to fill open positions. And you can see in the forecast, we expect to get down to just 0.7% before it rises slightly. And that's going to have a significant impact here. Next slide, please. Now to kind of wrap up our outlook here, our GDP growth forecast, a couple of things I want to point out on this chart here. We did get a contraction in GDP in Q1, 0.5%. That was primarily due to the front running of tariffs. We saw a large surge in imports as businesses and consumers tried to get ahead of tariffs. Much as we anticipated, we got a sharp bounce back in Q2. That 3% has been revised somewhat higher, but we are expecting GDP growth to slow to 1.3% in the third quarter. If you look at some of the GDP trackers out there, they're tracking a little bit higher than what we're forecasting, but they tend to come down as more data comes in. And then we expect GDP growth to be just below 1% as we get out to the end of this year before it rebounds slightly in 2026. Next slide, please. So with that backdrop, with the economy slowing, job growth slowing, unemployment rate rising, we do think the Federal Open Market Committee is going to continue lowering interest rates. We're currently, if you look at the midpoint of the Fed funds rate right now, it's at 4.125%. We're expecting 2 25 basis point cuts the remainder of this year in the October and December meetings, and then one more 25 basis point cut in January, which will bring the Fed funds rate to a range of 3.25% to 3.5%. Next slide, please. Now I'm going to share some data with you from the PNC, or a proprietary survey that's done by PNC of small and medium-sized businesses. This survey has been around for over 20 years, so it's got a good track record. We do this twice a year in the spring and in the fall. It's a survey of 500 businesses with self-reported revenue of between $100,000 and $250 million. Now, certainly that's a wide range in terms of the size of those businesses, but when you look at the average sales volume, self-reported, it's about $23 million. So I would describe that as being at the low end of middle market. Just to hit on some of these highlights here, looking at what's happening with demand and profits are cooling. So while key expectations, including demand, sales, and profit, remain above the survey's 23 historical average. The portion predicting increases in the next six months has gone down over the past year. Probably no surprise. Now, when you look at what's happening with cost concerns, no surprise, inflation remains a top priority, with nearly half of owners extremely concerned about cost increases, and that's little change from last spring when it was at 43%, and a year ago when it was also at 43%. Over half are bracing for higher prices from their suppliers in the next 6 months. Think tariffs. When you look at the percent who are expecting to expand their workforce, just over 1 in 10, 13% expect to increase the number of full-time employees over the next 6 months, and that's the lowest level since the fall of 2023. When you look at optimism, in fact, is outpacing key business expectations. What I mean by that is owner optimism for the U.S. economy and prospects for their own business for the next 6 months hit survey record highs. So definitely sort of a disconnect compared to some of the other metrics that I just shared with you. That's despite falling expectations for hiring, demand, and profits, coupled with rising concern about supplier prices and inflation. Now, in terms of what's happening with the supply chain challenges, overall expectations regarding increases in inventory levels have remained steady compared to 6 months ago. Nearly half of small business owners are currently facing a supply chain challenge, and that's likely to get worse as these tariffs take hold. And that's the same proportion of businesses say higher tariffs in 2025 are going to increase their supplier prices. No surprise there. When you look at what's happening with their cash cushion, nearly a quarter, 23% of business owners are expecting their cash reserves to be lower next year than they are now. That's up significantly from 17% from a year ago. And lastly, in terms of artificial intelligence, which obviously is a hot topic, a quarter of business leaders believe artificial intelligence is a technology investment opportunity that will have the greatest impact on their business over the next 2 years. Next slide, please. Now, when you look at some of the, I'm going to get into some more specifics here, some more specific questions. Looking at owners' expectations for sales increasing again over the next 6 months, that was at 61% in the fall survey, down 4 points from the spring, but it's above the historical average, expecting an increase, which is 54%. Next slide, please. When you look at what their expectations are for profits increasing, 48% expect profits to increase over the next 6 months. That's down sharply, down 9 points from the spring, and pretty much in line with the historical average. Next slide, please. When you look at, no surprise here, and this was a key question in the fall survey, given the backdrop with tariffs, the owners are expecting increasing prices to customers. That's 58%, up 5 points, and you can see that's well above the historical average, expecting an increase, which is at 46%. Next slide, please. And then you will look more specifically, we asked them, how much are you going to increase your prices to consumers? What I'm highlighting here is the percent who said they were going to increase their prices by at least 5%. That's at 36%, and that's up 16 points from the spring survey. And you can see that's well above the historical survey average. So no surprise given the backdrop with tariffs, but which indicates they're going to pass these costs along to consumers. Next slide, please. And in terms of what they expect to happen with demand for their products or services, the percent who are expecting demand to increase is at 58% in the fall survey, down 5 points from the spring. But again, it's still above the historical average. Again, what I'm seeing here is a disconnect to some of the prior results I just shared with you and what they're expecting in terms of demand given the slowdown in the economy. Next slide, please. And finally, looking at the number of full-time employees, I hit on this a little bit earlier, that 13% there, that's down 2 points relative to the last survey and well below the historical average of the survey at 22%. No surprise, and it reflects the slowdown we're experiencing in hiring the labor market right now. Next slide, please. With that, I'll turn it over to Holly.
Okay, thank you, Jay. And I should note to everyone, at the bottom of the Zoom webinar screen, you will see a button marked Q&A. Throughout the presentations from our three panelists, you are very welcome to lodge questions there, which we will collect, and that will animate the conversation in the interactive Q&A that follows their initial remarks with their slides here. So thank you, and you are very welcome to begin lodging those now. We're taking note of them. And Holly, over to you for the NFIB Small Business Optimism Index findings.
Great, thank you so much. It's wonderful to be with everybody today. Just a bit of background on the National Federation of Independent Business. We are a national large advocacy association, and we represent roughly 300,000 small business owners across the country and across industry. And since 1973, we have been surveying a random sample of our membership, asking them a whole host of questions, about 35 questions, related to business operations and their expectations of business conditions and economic conditions in the near term. So all of these questions have remained roughly the same throughout that time frame. And so we have a great historical database of information of how small business owners are thinking about their business, operating their business, and adjusting their business in various economic conditions. And so the slide deck that I have, just to orient yourself, we have the vertical line that shows the quarterly data on the left and monthly data on the right. And the quarterly data was from 1974, or the third quarter 1973, up to 1986, and then we transitioned to a monthly survey since 1986. So all of the data points are monthly, and we do release our survey of the previous month the second Tuesday. So we will be releasing the September data the second Tuesday of October, which will be our next release date. So the Small Business Optimism Index is our headline measure of the health of the small business economy. It's made up of 10 questions within the survey. Most of these questions are forward-looking, so looking at hiring plans, capital spending plans, outlook for business conditions, questions like that give us a general sense of where small businesses are and how they feel about the economy more broadly. So right now we are at 98, or the average is 98, and we're a few points above that. You can see in November, we had a large spike that was largely related to business expectations improving in the next 6 months due to the outcome of the election. So small business owners, not surprisingly, are very sensitive to taxes and regulatory burdens that make it more difficult for them to operate their business. And so we did see this dramatic increase in optimism coming out of the COVID period into 2025. Since the large spike and in the first quarter of 2025, we did see quite a slowdown. A lot of this largely had to do with uncertainty related to tariffs, how that was going to impact them, the policy disruptions and uncertainty related to that had the index declined quite a bit, but we have seen a bit of increase since then to just above the 52-year average. On the next slide, we have another index that we started looking at as an indicator of uncertainty. So for small business owners, Uncertainty is a very challenging place to operate their business, not knowing how to move forward with business operations, not knowing how to invest in their business or not invest in their business. And so this is often a stressful place for business owners, small business owners, to operate their business. Another little bit of background, the members that we're surveying, most of them are employer businesses, but very small. So our membership averages around 5 to 10 employees per firm. And the population of our membership is more concentrated in those in manufacturing, residential construction, retail, and services. So those would be the 4 big industries that we're looking at, although we are represented in most industry sectors across the country. On the next slide, we're looking at one of the more volatile questions that we do ask that is incorporated in our optimism index. And this is their general business conditions outlook for the next 6 months. And so here you can see the dramatic increase after the election. You can also see the increase in the 2016 election after the slow growth period from the financial crisis, and then the volatile economic conditions related to COVID, and a lot of the frustration related to the regulatory environment and the shutdowns of economic activity during that period. So we have seen that rebound recently after that kind of initial 2025 nervousness about what tariffs might mean for their business and how extensive that hit might be in either absorbing higher prices or the extent of supply chain disruptions. On the next slide, we have a good time to expand. So interestingly, for the most part, this is a question that we've raised a lot of interest in, because during COVID and sales were fairly supportive of high consumer spending, business to business spending. But we did see, for a lot of business owners, they were saying that it wasn't a good time to expand. Very few were saying that it's supportive. A lot of this had to do with their ability to manage price increases. So inflation was extremely high. That was a challenge for them to absorb those costs, pass them along to customers, and feel confident that they could still remain competitive. The supply chain disruptions were also a factor in their ability to secure inventories for their business. But also, and one of the main issues that remains today, is labor and being able to find folks to fill those open positions and look to see if they could increase their workforce. And so not being able to increase their workforce, having a hard time managing costs, created an environment where many felt the inability to, even if they could expand their business, that those opportunities were restricted because of these headwinds and challenges that they faced. On the next slide, we're looking at earnings. And again, this is a question that had interesting results in that earnings were declining, but this was largely because of businesses having to absorb those higher prices for their inventory and supplies, initially hitting earnings before they could pass along those higher costs to their customers. And for the previous number of decades, small business owners were very reluctant. They hadn't had a lot of experience in raising prices and feeling confident that customers would be receptive to that and still come to their business. It's a bit different with the small business owners and their ability to raise prices and feeling confident in doing so, in that the pushback of customers is largely, the pushback is on the business owner themselves. And so it puts them in a very stressful situation in trying to explain why they're increasing prices. So they're often very reluctant during COVID. That wasn't an option for most of them. And so they were increasing prices quite frequently. But initially getting the hit from earnings before they were able to do that. On the next slide, we're looking at actual and sales expectations. So we asked members if it increased or decreased, and all these are net percent. So we're looking at the percent that said increase minus decrease of increased sales over the last 3 months compared to the previous quarter. And then their sales expectations moving forward over the next 3 months. And so expectations does end up, generally speaking, outpace actual sales. Apparently, in this situation, small businesses are fairly optimistic. But we have seen quite a gap right now between small business owners' expectations and then what they're seeing on the ground. So expectations are still looking fairly healthy, and we've seen some improvement in actual sales increases on a net basis over the last few months. And then on the next slide, before I wrap this up, just looking at prices, because this is still one of the concerns that small business owners face. And as I said, it is a very generally uncomfortable place for them to have to increase prices and explain that to their customers. So we've seen a bit of a plateau and a recent decline over the last month of the net percent saying that they increased prices of their goods or service. So a dramatic decline from where they were 2 years ago. And on the next slide, we ask what they expect for price plans. And we've seen a decrease in the percent that expect to increase prices in the next quarter, which is a good sign that those inflation pressures have eased off quite a bit, and we're getting back to somewhere near the 52-year average. And as you can see, the last time we had a real sustained level of inflation, most of those business owners were not around to experience that. But we did see a bit of a spike right before the financial crash, but that was largely related to oil and gas and having to absorb those costs. So I will stop there and turn it over to Tuan. Thank you.
Thank you, Holly.
Thank you so much, Holly. And Tuan, over to you on RSM's findings on the middle market.
Thank you, Brett. First of all, big thank you to UCLA Anderson Forecast and Columbia Business School for having me today. Very happy to represent RSM today to share our outlook for the US economy alongside Jay and Holly. A little bit about RSM. At RSM, we are proud to be a leader in providing services to middle market firms, which accounts for roughly 1/3 of total US GDP. And that is where I like to focus on today in the next 5 to 7 minutes. I'll walk you through the latest findings from our middle market business index survey for the third quarter that was just released last Tuesday, along with some key takeaways from our special report on the impact of tariffs on prices. Now, you might ask, what is the middle market? We define the middle market firms as firms with annual revenue between $10 million to $1 billion. Most of them are private companies, so there's often not a lot of public information on how well they are doing. And that is why we created our survey 10 years ago. Next slide, please. So in this chart, we're showing our overall middle market business index. And if you look at it, you can clearly see that economic and policy uncertainty continues to weigh heavily on sentiment and outlook for middle market firms as we head into the critical holiday season. Firms are slightly more pessimistic in Q3, despite expectation for relief in 2026 when we have the new tax bill, and then expansionary monetary policies and fiscal policies. That uncertainty certainly led to a modest decline in sentiment. You can see that with the index falling from 124.2 to 122.5, and both figures are below the 4-quarter moving average of 130.5. Next slide, please. And in our surveys, for this quarter, we are really interested in 3 topics: CapEx, hirings, and inventories. And in this slide, we're showing CapEx, investment spending decision and performances. And declining sentiment is a key factor, putting downward pressure on CapEx in the 3rd quarter. As you can see, current investment spending remains below neutral, as many businesses continue to adopt the quote-unquote wait-and-see approach because of the uncertainties around tariffs. And we expect that this cautious stance to continue through the remainder of the year in the 4th quarter. However, there might be some rebound because of, again, the potential tailwinds from fiscal and monetary policies in early 2026, of course, assuming that there is no further economic shocks to the system. Next slide, please. And in terms of hirings, quite consistent with the overall market, hiring plans have also become more conservative because of that wait-and-see mode. Many middle market firms report pulling back due to ongoing uncertainty, and again, consistent with what Jay and Holly just presented. Next slide, please. In terms of inventory, it's going to be very interesting moving forward, especially in September and October. As you can see from today's data, we saw a downside surprise in terms of wholesale and retail's inventories. And because due to uncertainties, inventory management has become significantly challenging, particularly at U.S. ports because of rising trade tariffs, and many firms front-loaded the inventories orders in late 24 and early 25 to avoid expected tariffs, right? So because of that, inventory accumulation slow in Q3 for middle market firms. Only 35% of our survey respondents reported increasing inventory, while 44% expect to do so in the next 6 months. So maybe we're going to see an uptick in the next 6 months, but at the moment, inventory is still a point of concerns for middle market firms. Next slide, please. Moving on to our special report. This is a second key takeaway that I would like everybody to take home with, is that businesses have begun passing some of the increase in tariffs cost to consumers. Although most price increases have been under 50%, you can see from 1 to 9%, and then 10 to 24% here. Those are the most that we have seen. Slowing demand and persistent uncertainties also play a role here, because as the Economic 101 tells you, right, when demand slows, when uncertainty increases, firms are reluctant to increase their prices because it's not an easy decision, especially in the short term, and especially when you see a lot of uncertainties around, right? So again, many are adopting that slow but steady approach, wait and see approach to price increases as well. That being said, it is clear that we can see tariffs are and will continue to weigh on inflation, will be a key contribution to inflation moving forward. And we don't think, because of this survey data results that we have here, we don't think that is going to be a one-time event shock to inflation because of tariffs. We think that will continue to last over a much longer period than we expected. And most businesses raise prices within 1 to 3 months. If you look at the next slide. Yeah, in this slide, you can see that most businesses raise prices within 1 to 3 months after new tariffs take effect. Some wait longer, but most act within 6 months. So in the next quarter or so, is going to be very important to monitor inflation to see whether that impact will show up in the inflation report or not. And also because of the impact from inventory pressure, we think it's better to be cautious when it comes to whether the Fed wants to cut interest rate in the remainder of the year or not, because of inflation. So the Fed's jobs at the moment we think is more difficult than before. Next slide, please. So we also asked middle market firms a couple of special questions. And as you can see here, those questions are about how business has changed due to higher tariffs. One of them is whether goods purchased from within the US increase or not. And as you can see here, as expected, many are shifting to domestic suppliers. But interestingly, even companies not directly affected by tariffs are still considering price increases as you look at the second and the third charts here. So we think this is very important to emphasize because this is evident that this suggests tariffs may influencing inflation not only through the price channel, but also through the expectation channels, inflation expectation, right? Which is another key metric that the Federal Reserve is looking at when it comes to inflation. So if everybody expects prices to rise, then even when you are not directly affected by tariffs, you still want to increase your price, right? And looking at the broader picture, this is actually aligns with our argument that we have made in the last couple of years, is that in the post-pandemic era, because of the structural shift in the economy due to demographic changes, re-globalization, the disruption in terms of supply chain system, we might see a new inflation target level. Instead of 2%, we might see a higher one. And we are thinking about it's going to be around 2.5% to 3%. So businesses, especially middle market businesses, are adapting to that new reality. Next slide, please. Yeah, and for this last slide, as you can see, the impact of tariffs on profits have been relatively limited if you look at the first chart here. Likely due to, again, businesses absorbing rising input costs, slowing demand and uncertainties. However, if you look at the third chart here, our executives of the middle market actually confirm the fact that because of tariffs, they are pulling back in terms of hiring plans. So again, the wait and see mode for not only hirings, but also for CapEx. Yep. And that's my last slide today. Back to you, Brett.
Great. Thank you very much to all three of our panelists. We have a number of questions that have come in during your presentations. To our participants and audience, I'd encourage you to keep logging those questions. We may take a few of them as a set or combine them in some cases in order to ensure we can cover as much material as possible. But one question to kick off to all three panelists that appeared in a few questions was about the regional breakdown of some of your findings. Could all of you give us a sense of how the data varies in broad terms across major regions of the United States or within individual cities? Jay, I'll go to you first, and then to Holly and Tuan in the order of your presentations.
Well, thank you, Brett. And so one of the things that we do at PNC is to produce a U.S. macro forecast. We're just starting to do more regional work. We hired some additional resources, but we're not actually forecasting anything beyond the national level at this point. Obviously, there's a lot of differences. And I point back to the PNC Small Business Survey. One thing we do in addition to that national survey, that 500 sample of businesses, is we do regional overlays. We did Dallas, Chicago. There's 4 of them we do. Cleveland was the third one, and I don't remember the fourth one offhand. So we do have some regional results in terms of what those small business owners are thinking. But for the sake of time, I just didn't have the time to present those findings. But we do have some of that data available internally.
Jay, could you give us a quick characterization of them or any broad distinctions between them?
We're just getting those survey results in. We got the national results in just a week or two ago, and then the regional overlay stuff follows. So we're just getting wrapping our heads around that now.
Okay, great. Holly?
Yes, so similar to Jay, we have our national sample. We generally don't break it out into regions. In combining, some of our monthly survey data, looking at it by region, so we have enough respondents to have some generalization. For the most part, the Southeast members of NFIB seem to be a bit more optimistic, a bit stronger in sales, and then in the Northeast seem to be lagging behind for the most part in our survey. But those are kind of the big generalizations. And then when it comes to, their biggest problem, which is the vast majority of them is related to labor at the moment. So when we talk about hiring plans or unfilled job openings, and that's slowing down over the last number of months, it's hard to tell whether that's related to the supply of labor or the demand for labor. And it's probably a bit of both, because when we look at the industry breakout, those in construction and manufacturing transportation, still very, very high levels of demand for labor, and then in retail and some of the other industries. So we have more of an industry breakout that we look at versus region, but those are the two main extremes for the regional outlooks.
Yeah, so unfortunately, our survey doesn't focus on regional data, but I think Holly just raised a very good point that instead of looking at regional data, you can also look at industry data. Because most of the time when you look at regional data, they often lack national data by quite some time. So at the moment, because of uncertainties, you might only have 1 or 2 months of data points. So I don't think that's reliable enough. But if you look at industry and then extrapolate from industry to regional, then I think that is a good approach.
Great. There was a follow-on question to that, which asked about the notion of uncertainty within your surveys and how that is understood or configured in your respondents. Could you delve a little bit into how you think about uncertainty characterizes the respondents who are participating in your survey? Are they focused on one particular thing, on the economy as a whole, or on a wide or narrow distribution of possible outcomes?
So for our survey, our uncertainty index, it's not a question to our members about uncertainty specifically. It's taking responses from 5 questions that have a response of I don't know or uncertain. So we're looking at the actual responses that they can't confirm whether they anticipate higher sales or lower sales, whether they think that it's a good time to expand. Business generally, we have yes, no, and uncertain. So we take those uncertain responses and built an index around them.
And I'll just add that one of the questions we ask in the PNC Small Business Survey is whether uncertainty is increasing, staying the same, or decreasing. And if it is increasing, what's driving that? And then they get a multiple choice type question. And probably not surprisingly, trade was far and away the #1 category of uncertainty for small business owners, which you'd expect with the tariffs.
Yeah, for us,
Absolutely.
we don't have a specific question on uncertainties, but we can extrapolate from the fact that they answer the questions on current performance versus future performance. And we do see a huge difference, a huge gap between those answers. That means that there's a lot of uncertainties around what you're going to do now versus in the future.
Thank you. There are a couple questions asking the panelists to sum up your big takeaways. You presented a lot of very insightful data that gives us some differentiated views on different parts of the national economy and the circumstances for small and medium-sized businesses. Could each of you sum up what you think the 2 or 3 biggest takeaways are from the data that you presented? And I'll throw it to Holly first.
Sure. So one of the big takeaways, and especially looking over this past year, are the economic shocks that are happening. The big policy shifts in DC are causing a lot of uncertainty among small business owners. So whether that's tariffs, immigration, those are obviously the 2 big ones, put a lot of kind of concern and apprehension in small business owners trying to figure out the magnitude of how that might impact them over the course of this summer, with all those pauses related to trade agreements and tariffs and the threat of high tariffs, and then the 90-day pauses. And sometimes now I have my running spreadsheet and I can't remember where things are exactly, but that's a lot of small business owners are kind of in the same boat. And so as these pauses were extended, there was a bit of relief in them trying to be able to have some time to navigate some of these hurdles. And so that optimism index, that's the overall health, has improved. And that's likely one of the components to that, is that just these policy shocks in trying to figure out how they're impacted and having more time to navigate has been helpful. And then there was the tax relief and extending those tax provisions, and the more friendly regulatory environment on a federal level have helped small business owners navigate running their business. And so that environment has been a bit more supportive than it was, say, last year.
Sure. Jay?
Yeah, and I'm going to focus on one takeaway that I discussed, and layer on top of that one thing that I didn't mention during the course of my remarks. But the single biggest takeaway for me is what's happening in the labor market. As I noted repeatedly, a significant slowdown in job growth. What I didn't add, for the sake of time, is that we got the annual benchmark revisions from the BLS a couple weeks ago, and 911,000 fewer jobs were created in the 12 months ended March of 2025. So job growth is significantly slower than what we thought it was. Not only that, some of those meager job gains, for example, in the month of August, 29,000 jobs, those could be revised into negative territory. And that gets back to the indicator that I showed, that typically it suggests that a recession is imminent or underway. The other thing I'd like to add is that we've done some research in terms of who's paying the tariffs so far. And we estimate that 60% of the tariffs so far have been borne by U.S. businesses. Another 25% has been passed on to consumers, and 15% has been borne by foreign exporters. Now, in turn, I'll just add something very quickly. We think the effective tariff rate right now is 10%. You have to remember it was 2.5% prior to Liberation Day, so it's up fourfold. And we think when all is said and done, we're going to end up somewhere around 15%. Obviously, a lot of nuances there in terms of what happens with China specifically and some of the other big trading partners.
Yeah, I
Juan,
think,
would you like to add to that?
yeah, Jay, that is a good point in terms of the effective tariff rate. And that's also our main concern at the moment, especially for middle market firms, when they will be affected a lot more by tariffs and rising input costs than bigger firms. And in terms of their spending, investment, and planning and hiring, they are a lot more limited. They are not like bigger firms that can spend on AI investment no matter what the economy looks like, right? So in terms of tariffs impact on input costs, that is going to translate on inflation, right? And what happened to inflation will impact what the Federal Reserve decision will be in the next quarter or so. And for middle market firms, they are very sensitive to borrowing costs. And with inflation rising, even though you have a couple of interest rate cuts, but those will only affect short-term interest rate. In terms of longer term interest rate, the 5 years, the 10 years, or even the 30 years, those are more important to our clients, to middle market firms, than the short-term interest rate. And looking at those rates at the moment, there's not a clear sign that those will and go down anytime soon, because again, uncertainties, higher inflation, so you demand a lot more on premiums on those long-term bonds and treasuries.
And I'll just
that's
add
a
one
great
thing on
point.
top of that quickly, if I might, because Tuan brought up a good point about inflation. When we look at the core PCE deflator, which is the Fed's preferred measure of inflation, sitting at 2.6% year on year now, we just updated our forecast last week, and we've got that rising to 3.3% in early 2026 because of the impacts of tariffs. And this gets to the point Tuan made earlier in his comments. You know, the Fed is sort of in a tough spot here, and they obviously have decided that they're more concerned with the slowdown in the labor market, and they're willing to tolerate a little bit higher inflation, mainly because they're convinced that tariffs are going to be a one-off increase in inflation, and then we'll just go back to the 2.5% gains in inflation that we've seen historically.
And both of your comments are important reminders that small and medium-sized enterprises are particularly sensitive to borrowing costs, and none of them borrow at the very short end of the curve. They are much more exposed to the belly and longer end, where yields remain higher than they were this time last year. One last question that is maybe best tipped toward Holly, but I invite all three of you to come in. How are you seeing policymakers respond to the findings that you have presented today or in the recent past? In your discussions in DC, Holly, what is the kind of reaction you're getting to the picture you paint of how small businesses are developing?
So one of the main discussions that we have is the labor market, and that there is a slowdown for certain industry sectors among small business owners, but then also other industry sectors are having a real challenge in finding applicants for those still very high levels of unfilled job openings. For instance, in construction, about half of our firms still say that they have a job opening that they can't fill. So it really is on ends of the spectrum as far as where you are in your industry of the labor constraints that you have. And then on the inflation side of things, you know, that is still an ongoing concern about where prices end up as far as, you know, the cost of their goods and supplies. You know, as I believe both Jay and Tuan said, that small business owners are in a particularly challenging position because they weren't able to kind of overstock and get those inventories in large quantities, because small business owners, they are short on cash for a lot of them. Interest rates are high, so there isn't a lot of interest in borrowing and financing those orders. And so small business owners are really having to struggle through that transition and absorb those higher costs if they're directly hit in the form of tariffs. And so, you know, those are the big challenges. But then when we ask about the health of their small business directly, just kind of their self-evaluation, most of our members and small business owners say that their business is still doing okay, either excellent or good. So right now, it does appear that the general health of their business is okay and has a pretty solid foundation, but those challenges still remain as far as tariffs, inflationary pressures, and labor pressures.
Last words from Tuan and Jay. Big messages for policymakers here?
Now, I was just going to add that as we went through the results initially of our latest survey, we're trying to grasp why small business owners were still optimistic when some of the other indicators, the answer to those questions indicated otherwise. And I think that the conclusion we came through was number one, they've been through very tough times before, whether it was the global financial crisis or COVID, and came out on the other end. And part of of my thinking was that small business owners tend to be optimistic by nature. If you look at the data in terms of the failure rate of small businesses, you'd have to be optimistic to open a small business. I think that's why they've always got an optimistic outlook on the future.
Tuan, a
Yeah,
last word from you.
yeah, I would say that in our case, for businesses, uncertainties is always the number one enemy, and hopefully in the future we won't see any kind of policy shock to the system anymore. Or if we have new policies, we should give businesses some time to react and adopt.
Well, I think that is a very good message to conclude on. And with that, our conversation is going to wrap up, and I will hand the baton back to our host, Clement at UCLA, to wrap things up.
Okay, thank you, Brett. And I think that is such a good question to end this conversation on. It's such a curiosity that it seems like, from an economic perspective, that smaller businesses are actually more disaffected by some of these interest rate and tariff policies, at least in the short run. Yet we actually see them, at least in these surveys, be more optimistic. And so there is the curiosity there, whether that optimism is warranted or whether there actually is another reason for them, for them to actually be more optimistic. So again, the economy is sending a lot of mixed signals, and that's certainly another dimension of these mixed signals we are getting currently. But with that, I'd like to thank our panelists. We have Jay, Holly, and Tuan. It's been wonderful to hear your company's takes on the current business environment. I'd also like to thank Brett, my co-host here from Columbia Business School. It's been a real pleasure to hear this conversation. The recording from this panel, this webinar, and the slides will be available online on the webpage for it, and we'll also send out a follow-up email with it. So you don't have to go searching for it. And then lastly, I'd also like to notify that the UCLA Anderson Forecast has our upcoming conference next week on October 1st. We are a public institution, so these conferences are available online for free, but you can also register to attend in person if you will. And then later on in October, on October 15th, we have our regional San Francisco Economic Outlook Conference in San Francisco as well. So all the information about those conferences are on our website. Thank you.